Delighted to be here. Thank you to the Illinois Soybean Association for the invitation to be here today. If you've heard me speak before, you'll know that I sound a little bit different today. I'm a proud grandparent of 4 children, but we had a party for my 1-year-old granddaughter on Saturday, and I got a gift of a cold. Those of you that are grandparents know that sometimes your shields go down, and mine was, and you can't resist them. So I might have to take a break or two for some water. And I guess my job this morning is kind of to bring you guys all back down to reality after all the excitement from Dr. Bilo and in his presentation. So, you know, they don't call economics the dismal science for anything. And so just get ready. No, it's really not that bad. Okay, we're going to start at a really high level in my remarks in the next 20, 25 minutes. I want to leave some time for questions. This chart shows U.S. net farm income for the last 25 years in nominal terms. And a couple things that I really want you to notice. One, look at how high farm income was from 2020 through 2022, peaking in 2022 at over $180 billion. The average is just under, I think, read my notes, $89 billion. So we had an extraordinary period of high incomes in the farm sector. The second thing to note is how fast we're coming down from the peak. The latest projections on this chart for 2024 are down to around $140 billion, a drop of about $40 billion. So it's kind of a sudden reversal. That's the second thing to notice. But it's also important for perspective, and that's why I show this chart, that the sector still has experienced overall income that is way above average, which is kind of interesting compared to some of the headlines you see. But if you dig down behind that, what we've seen is kind of an unusual divergence in the fortunes of the crop sector compared to the livestock sector. And so the livestock sector is doing better than the crop sector. But since much of Illinois agriculture in particular is focused on the crop sector, that's going to be where we'll find a lot of the negative news. So that's just kind of the broad picture as we look at the outlook for Illinois and Corn Belt agriculture. Now I'm going to go into kind of, okay, where might we be headed from here? And just a couple quick charts to show you. It is and it isn't that complicated, because this chart just lays on top of net farm income the Illinois price of corn. If you know where the price of corn is going, you have about a 2/3 chance of predicting where U.S. net farm income is going. And since corn and soybean prices are so highly correlated over time, it's about the same message for soybean. So if you know where corn and soybean prices are headed, then you pretty much know where farm income in the U.S. is headed in general. So I want to share with you how I think about corn, soybeans, and wheat prices. This is my basic template for these crucial markets and how I think about them kind of at a 50,000-foot level. The chart I'm showing you right now shows the monthly average price of corn in Illinois going all the way back to post-World War II, back to 1947. okay? And there were pretty much two obvious eras, one in the 40s through the early 70s, when the average price of corn was $1, I gotta read my notes here, $1.28, since I can't see the screen very well, and then it was $2.43 from the basically 1973 through 2006, okay? This was the data that my good friend and colleague, Darrell Good, and I had in front of us in the summer of 2008. That's why I show this data this way without all of our recent data. And we all know that grain prices had exploded in 2007, 2008, and so we were getting flooded with questions about, is this just a temporary spike? Or is this going to be a permanent increase in the average price level like we saw in the early 70s? So Darrell and I did what you should never do as an economist. We really stuck our necks out, and we made long-term price projections based on our perception of number one thing, was that the ethanol-driven boom in grain prices was real, and that the ethanol boom was powering a permanent increase in the average price of corn. And without going into the details of how we did it, the chart shows that we forecast that average to be $4.60 a bushel. Again, and remember, this was in the summer of 2008 when we made that $4.60 per bushel average price projection. So now, 17 years later, and that's the advantage of having a long career, you can actually go back and test how well you did some of these things. So 17 years later, how did we do? Came within 2 cents. In the last 17 years, the average price of corn in Illinois has been $4.58. So I should just drop the mic, exit the stage. I will never make another forecast that's that good the rest of my career, I guarantee it. But actually, equally important in our projections, we also forecast the range of prices based on historical volatility of corn prices, and we captured that pretty well. It was interesting, when Darrell and I put out these projections initially, we came to the conclusion that we'd actually gotten it about right because no one agreed with us. You know, I know this is mainly an audience of people in, the agronomic fields, but that's really how you can judge things as an economist, if you get it about right, if no one thinks you're right. In 2008, we had the optimist who said, oh my gosh, $4.60 when prices were $6 or $7 a bushel, that is, you're way too low. On the other side, you had the pessimist who were thinking of $2.40 corn saying, oh my gosh, you're dramatically way too high. And that was pretty much the reactions that we got. And we said, nope, we're going to stick with $4.60. We were stubborn. But most importantly, we said, look at the huge range of prices that you should expect. And we said we thought about $3 would catch it on the downside, and then something like $7 or $8 on the high side. That turned out to be also equally true. And that is the trading range that we have been in for the last 17 years. And right now, I don't see any reason to change that as an expectation until something really dramatic happens again in terms of a new form of demand. So that's corn. And since this was a corn ethanol-driven boom, we started with the price of corn, and then we priced soybeans and wheat relative to the price of corn. And we were a little bit low on beans. We had predicted a price of $11.04, and the price turned out to be $11.30. So we came pretty close on soybeans. We were just a little bit too low on soybeans, but again, we were a little too high on the high, but again, the low was also important. So basically, $4.60 corn, a little higher than $11 beans is what we predicted, and that's exactly what we've gotten. Wheat, not as important in Illinois, but we predicted that price to be $5.80, and it came out to be $5.71. So again, pretty close. So as we're thinking about where the sector is going to go in the long run, those are the numbers that I use. Those are planning values, obviously with a huge amount of volatility. So that was kind of the second step that I wanted to share with you. Start with the broadest measure of sectoral income. Grain prices are crucial, and this is how I think about grain prices. Next, if you look at, in particular, if you go to corn prices, stepping back a bit, you can see we're currently clearly below the long-term average. And we have been below the long-term average for a little bit less than a year. So what can we say about what might happen moving forward from here? We're sitting below average. And so this is the analysis that I've done that's relative to that question. So what I've done now is I've drilled down in the data here on corn prices. I'll show soybean prices in a minute. In this new era, the last 17 years that started in late 2006, okay? So that's all you see there, okay? The new era of corn prices. And now what I am marking out for you is the length of time that we've been below average and above average in all of these different swings the last 17 years, above and below average in the corn market. And what you can see is a lot of range in those numbers, from as short as 8 months above to, I think that's 80 months below the average. So there's a lot of range in the time that you can spend above and below average. But that's the history that we have available to us. And as I show here, the average amount of time that we have been above average is, I believe it's 25 or 26 months, and the average below is 42 months. So that's the data that we have. 42 months, you can think of it as around a little more than 3 years. So kind of some round numbers to help remember is that our typical behavior is around 2 years above average and around 3 years, maybe a little bit longer, below average. So if we've been just a little bit under 1 year below average in corn, history would suggest we'd probably have at least another couple years below average. And that's just kind of a typical cycling of prices that we see in this sector. And it helps us to get perspective on what I think is the critical question facing the sector, which is grain prices, how low, how long? And that is, I think, the best answer that we can give from the available history of prices. That, again, it's important to remember that these periods of lower prices, they don't last forever. They, probably the thing that is most concerning when people ask me questions is, we want to avoid that 80-month swing that we had from basically 2013 to August 2020. That's a long time below average. But that's also very, very unusual if you go back the last 50 years to see it like that. So that's what it looks like for corn. That's what it looks like for soybeans. Pretty much the same kind of picture from soybeans. The swings are a little bit more evenly distributed in terms of time for soybeans, but still roughly that kind of 2 years above, 3 years below is the average. But again, there's some variation in that over time as well. So with that background on grain prices, what I want to do is now move and talk about kind of continuing to telescope down, and I want to talk about the evolution of returns to corn and soybean production here in the Corn Belt. And this is great data that Gary Schnittke, Nick Paulson, and colleagues here on the FarmDoc team at the University of Illinois produce. This is their latest data on the per acre returns, net returns to a farmer on a 50-50 basis after cash rent, okay? After cash rent. So some things I want you to look at. There's obviously a lot of variation. Prices are doing this. Yields are doing this. Net returns are going to be volatile. First thing to notice is that the average, after paying all costs, including cash rent, the net return to the farm operator averages really close to $100 an acre. When you just kind of squeeze everything out of the sector, account for everything, Illinois farmers, in the long run, are willing to farm for $100 an acre. That's the return to their management and labor that they provide to the operations. If you can do better than $100 an acre, then you will rapidly increase the size of your farm operation. So that's the key. That's the benchmark. So now look at what the sector experienced in 2020 through 22. I didn't think we were ever going to see, at least for a long, long time, returns to corn and soybean production that beat some of those that we saw in 07 through 12. But 2022 did. In those 3 years, we averaged a return of $240 an acre on a 50-50 basis. Almost 2.5 times normal. So that's really important as we think about moving into thinking about the financial prospects of the sector, is the tremendous profits that the sector experienced in 2020, 21, and 22. The total net return during that period was $688 per acre. Again, remember, that's after, in this data, paying average cash rents, according to the FBFM data. For example, in 2024, I believe that was $359 an acre is the cash rent figure that they use. Okay, big profits through 2022. And you can see then, wow, a lot of red for 2023, 24, and the projections for 2025. Basically, if you add those up, we're giving back about 40% of the profits from 2020, 21, and 22. That's the bottom line. It's an unprecedented period of losses that you can see in 2023, $93. 2024, current projections are $91 loss, and 2025, $58 loss projection. Actually, if you can imagine it, the 2024 projection looks a lot better than it did last summer when the price of corn was below $4 and we didn't know that we were going to get some of the big yields that we got. So it's a little bit better that way. So clearly, we are in a period of substantial losses. Maybe even a bit surprising how big they are. How did we get there? And that's what I want to show with this chart. This shows the change on the revenue and cost side from 2019 to 2024 for that 5-year period. What's interesting is gross revenue on a combined 50-50 corn soybean basis is actually way up over the last 5 years. It is up almost $150 an acre. So revenue has not gone down. But the issue is how rapidly costs have escalated. You can just go through the categories. Direct costs are seed, seed, fertilizer, et cetera. That's up about $75 an acre. Power costs a little under $50. Overhead costs a little under $50, about $40. Total non-land cost over $150 up. Land cost, which is cash rent, is up about $80 an acre. So you can see all costs, including cash rent, are up over $250 an acre, and with gross revenue up under $150 an acre, we see the farmer return has dropped by over $100 an acre. So right now, I would describe the situation of Corn Belt agriculture. We have a cost problem right now. The cost structure that has gotten leveraged into the sector during the boom years is not sustainable in our current down cycle for grain prices. Now, the question is, again, that's why I say the key question for the sector is grain prices, how low, how long? Because you can withstand these losses and you can absorb them out of the liquidity built up during the boom years, but only if the losses don't persist for too many years, for too long. And so that's why how low, how long is a critical question as we move forward. Key aspect of thinking about the financial situation moving forward, what happens in Washington, D.C.? And probably you're all already aware of this. In the political battle over funding the federal government right before Christmas, crop farmers got a very nice $10 billion Christmas present from the U.S. federal government. As a side note, to me, I found it fascinating that, in essence, we don't really have a lot of financial stress in Corn Belt agriculture yet, but the mere projection of it, like I'm showing here, resulted in this nice $10 billion gift. And again, Gary Schnicke and colleagues have done great work outlining the size of these one-time payments, okay? They're not connected to any Farm Bill programs. It's just a one-time, ad hoc, low return payment that's going to result in some pretty nice sized checks. There are some payment limitations on them. If I remember the numbers right, $42 an acre on corn, and I cannot read that. I think it's around $30 an acre for soybeans. So 40 and 30 roughly. Those checks will be coming out sometime in the next few months in 2025 for the 2024 crop. So this is what the revised 50-50 returns look like. So we were at minus 91. That raises that to minus 54. So those checks are going to be nice, and they're going to offset a chunk, but basically all they're going to do on average cash rent land is offset some of the losses. It's not going to push us into profitability unless you have much lower cash rent rates and so on. There'll be individual situations where that can be the case, but it's important to keep that in perspective. But we can see that, you know, losses projected right now for 2025. Anybody want to guess? You know, most people in here, I guess, have raised kids, and once you have demonstrated that you're willing to do this once, what do you think the chance is that the federal government might be willing to do this a second time? You know, I wouldn't count on it, but it wouldn't surprise me if it happened either. Okay, before I finish, I want to go through, where's the loss? How am I doing on time? 5 minutes. I will see your 5 minutes and raise you 1 minute. No, I'm just kidding. Talk a little bit about land prices. I mean, we've seen tremendous increase in land prices over time. In this latest boom period, we have seen land prices go up basically a third. And the latest auctions, the data that I've seen, there's variability, but land seems to be pretty much holding its own right now. Here's the way that I like to think about land prices. So the red line is simply the return on holding 10-year Treasury bonds. That's the red line. Think of that as the required return in the land market. That's your target, is the red line. And notice that that's come down a lot in the last 45 years. And after the financial crisis and COVID, it got down to 1 or 2%. But with our newfound policy of fighting inflation, it has driven interest rates up over 4%, at least on this 10-year Treasury note basis. And that yield has continued to climb. So, with respect to land prices, the current return on land is the blue. It's just rent divided by land price. And over time, that ratio basically tracks the required rate of return. It ain't rocket science. Where we are now is that the required rate of return's been going up, and the current return is getting pressured on farmland. So I'm not projecting any disaster in the land market, but it's very hard for me to see how we're going to see further appreciation, at least for a while, in the land market from the levels that we had seen in recent years. Wouldn't surprise me if we end up, you know, driving land prices back maybe 5–10% during this time period. Okay. A little bit now about really short run, where are we headed in the grain markets. This shows the WASDE balance sheets and then my personal balance sheet for 2025-26. So on the corn balance sheet, the USDA gave us a big surprise last Friday when they said that the corn yield was 3.8 bushels an acre less than they said it was in November. We could have a very nice debate about the accuracy of what that was and what it means, but I don't really have time to get into it. I'm looking for a bump up in corn acres, and I'm going to stick with a trend yield of a little under 184 bushels an acre, giving us a production of 15.4 billion, total supply of 17 billion bushels, total usage about 15 billion bushels, which would give us a ending stocks of a little under a billion bushels and a stocks to use ratio of 12.9. And it's hard to see on that slide, but a price of $4 a bushel. That's where I see the corn market right now. Soybeans, less acres this year, got a trend yield a little under 52 bushels an acre, total supplies of 4.8 billion, total usage of 4.3 billion, see us building stocks back up to above 400 million. Not nearly as severe of a situation as I had feared a few months ago, and I've got us at a price of $10 a bushel for the next year. So 4 and 10 is what I'm looking for, a continuation in the 2025 crop of prices below those long-term averages, given the fundamental situation. So now I'm going to talk about things that keep me awake at night, looking at the economics of this sector. One is the potential huge supply of coming out of South America. The Brazilian soybean crop looks like it could be a monster, and so that could really weigh on prices moving forward. But this is what really keeps me awake at night. We've got a new administration coming in. President Trump has loudly proclaimed his intention to impose 25% tariffs on Canada and Mexico on everything, and an additional 10% tariff on goods from China. The one thing that I learned thinking about the economic implications of President Trump is in Trump 1.0, when he makes a pronouncement on economic policy, you'd better take him seriously. So I'm taking him serious that this could happen on Monday when he is inaugurated. It could be an executive order that quick. And we have some history about what happens if these countries retaliate. Who's our number one buyer of corn by a big margin? Who knows? Mexico. You know, this is the danger of this policy, is what economists call the tit-for-tat retaliation. And it happened in 2017 and 18 with China. And so on this chart, I show Brazil and US price for soybeans. And when the trade war began, you see normally our prices for Brazil and the US move very closely together in the export market. But when the first time we put the tariffs on China and China retaliated on soybeans, a $2.50 a bushel gap opened up between Brazil and US prices. Basically, China took their business to Brazil. What people, I think, on that episode, a lot of people kind of downplay that experience because it honestly didn't last that long. The worst of that was only about 6 or 8 months. The reason is the second thing I put on the chart. Coincidentally, China went through the worst commercial livestock disaster from disease in, I think, the history of mankind, with the swine flu in China. Just decimated their herds, so their demand went down from Brazil and prices came back together. Unless China gets a new swine flu disease, that's not going to bail us out this time. So I'm probably a lot more nervous about this than anything else as we move forward, but we're going to know a lot more, I think, in a week or two. So I don't have time on that. There, if you want to know more, I have a website, scottirwin.com, where you can post nasty comments about me if you want, my forecast, and I wrote a book. So that's it, DeLoss. Thank you very much. I'm a little over, but I can take a few questions if you want.
We need to get the one or two. Okay, it's your panel next, so if you say one or two. One or two for Scott?
Oh, I must have depressed them.
There's one right in the middle.
Yes, sir.
Editorial question maybe, but I agree with your comments about the tariffs and that's the concern, but agriculture, at least my perception is, overwhelmingly supported Trump. Can you explain that dichotomy?
So the question was about tariffs' effect on agriculture, and yet agriculture in general supporting Trump.
Well, I would say from a political economic standpoint, you know, everybody weighs different issues in their importance when they decide to vote. And so, you know, agriculture weighed things and overwhelmingly went for Trump. But I'd like to, all fall, I've described talking to farmers that I know, because my family still farms in Iowa and a lot of connections there and here in Illinois. I said, farmers were as nervous as a cat on a hot tin roof pulling the lever for Trump. That's my description. They all knew this could be coming down the pike. But I will say this. I think the $10 billion package shows that there's likely to be a significant degree of what I call indemnification. If this happens again, and it looks likely to me, I think there'll be at least some significant efforts to backfill on the price, like we saw last time with trade payments. At least I'm hopeful. I don't know if that answered your question or not, but that's the way I think about it. Thank you.
All right.
All right.
Scott, thank you very much.
All right.